All right, guys. Thanks you for joining us today. We've got a really great show. My name is Besim Tafilaj. I'm one of your hosts.
And as always, Adam the Boz.
I'm really excited today to talk about this topic. I think it's something that's going to be very, very interesting to you guys. It's one of the reasons that banks have issues with specific companies. We're going to talk about today some of the top industries that banks have difficult times lending to. So why don't we go ahead and get started, Adam? We'll go ahead and have you kick us off. What's one of the top industries that the banks have a hard time lending to?
Yeah, let's talk about something in something I've mentioned in other podcasts. So something that hits very close to home, being here in the great state of Texas, Houston specifically. Let's talk about the oil and gas industry and why that's been very difficult to lend into the last 5-6 years or so.
Yeah, well, one of the things that you see with the oil industry is there's big cycles of the business. There's a lot of big ups and downs. The companies do very well. Oil jumped to $147 a barrel, then it'll drop to like $10 a barrel.
Right.
And so those big fluctuations, when you see them coming through as a banker, you get a lot of concern because you're like, how's this company going to repay? What's their management style? Are they going to be one of the first companies that go out? Is their overhead too high? So those are big things that kind of come out when you're looking at oil and gas companies and service companies and things kind of related to oil and gas. Right?
Yeah, in oil and gas, let's be honest, especially here locally in the United States, it's a different beast for local companies to be profitable at a lower barrel price than it is in the Middle East, where they could be profitable at $5 or less dollars a barrel. Here, there's a kind of a de minimis amount of what you need from a price per barrel to be profitable. And that's why, you certainly see the closer you are to the drill, the harder it is with all the overhead and capital costs that it takes to fully extrude and then process that oil for different types of applications.
Yeah, another big issue with the oil and gas is the environmental implications.
Absolutely.
So, as banks, we're kind of sensitive to our companies having these extra things kind of disrupt their business. One of the big things that could happen is something like an Exxon Valdez oil spill or, some kind of a drilling accident that causes a massive destruction to the environment. And that's going to really have a really big impact on the company, and a lot of times it'll put companies out of business completely.
Right.
And so if you're not an Exxon, you're not a Shell, you're not one of these huge companies, maybe you're a smaller company, even you're in the oil and gas industry, you're going to be dealing with chemicals, you're going to be dealing with oil and different things like that can be hazardous to the environment, and there's a big implication to the effects of environmental damage. So
right, yeah, and it's a very highly regulated industry as well. Whereas 10 years ago, when companies were blowing and going, the rules and regulations were a lot different than they are today, and obviously they're becoming a lot more stringent today. So we see a lot of those headwinds that kind of change some of the course of business, and it's very difficult space to operate in.
Yeah. Well, let's kind of switch gears here and go to a type of business that a lot of people get into. It's a little bit lower barrier to entry, and a lot of people like this particular business. We frequent them all the time. Let's talk about restaurants.
Sure.
Because I've been to multiple banks. I haven't seen one that really is big on restaurants.
Right.
What's some of the issues that we see with that?
Restaurants are tough insofar as, at the end of the day, from a bank's standpoint, we're really talking about two things. We're talking about a cash-based business, and then we're also talking about real lack of collateral here. So when we're talking about a cash-based business, and cash kind of fuels the cycle of the business, it really is difficult to justify any type of lending need because you're getting paid on the spot for services and products rendered. It's very difficult to justify, let's say, a line of credit for a restaurant because you have the cash available to then fund purchases of food and so on and so forth. So they're cash-based businesses. That's the first part. Yeah. And the second part is there's no inventory. We're not going to take hamburger patties as any type of food item, perishable, is not really good collateral. So outside of the brick and mortar that is the actual restaurant, there's really no collateral to take in most restaurants outside of potentially kitchen equipment.
Yeah, and then like you said, what are you funding? You're getting paid whenever the customer leaves,
Right.
you know. But I think another big problem with the restaurant industry is just historically there's been a low barrier to entry, and a lot of people actually fail at that industry.
Right.
And so if you're a newer business, haven't really been established, don't have multiple locations, it's going to be more difficult for you to get financing because companies and banks are going to be worried about the sustainability of your business. And a lot of times these companies, restaurants, when they first start, they'll be kind of like a hit, a fad, you know, everyone goes, tries it out, likes it. And then all of a sudden, a few months later, it's like nobody's there.
Yeah, I mean, what is the failure rate of restaurants? 8 out of 10, 9 out of 10? It's an
pretty
astronomically
high,
high
yeah.
number where, now that's not to say banks won't lend in that space, but, you know, take our bank is an example, or just, you know, a larger box bank. We might do franchise lending. We will lend into that space so long as, you know, there's franchise lending, you know, an established, long-running company and organization, let's say like McDonald's, for example. You know, you could potentially get into some of those, but that's different than your mom and pop restaurants and kind of your standalone entities.
Yep. Well, let's move on to something really similar to restaurants, and that's kind of retail space. I call
Right.
it similar kind of because, you know, you're getting paid up front. You're not up front, but you're getting paid at the time of sale. But just in general, what are some of the issues that you've seen kind of with the retail?
This is a very tough industry given the trends over the last 10 to 20 years, and that is strictly as it pertains to online competition. You know, that the Amazons of the world and so on and so forth, they make it exponentially easier to view inventory, purchase inventory, have it shipped. You don't have to go out, and is really hampering the current landscape of the retail environment when you have a much easier and more convenient option when you're buying online.
Yeah, I mean it's pretty amazing how much Amazon and this online retail has really hurt that industry because you know you're betting that that you're going to have better stuff in the store than they can carry online, and that's not really going to happen very frequently. And not only that, but you're going to be carrying a lot more inventory in the store that you
Right.
might not sell. Where you know online you'll be able to do some drop shipping, different things like that, and that takes out some of the risk and shortens that
risk,
working
and it
capital
really,
cycle.
you know, from a retail standpoint, it ups your cost. You know, you have to sell at a certain price to be viable once you account for all your overhead and carrying cost and so on and so forth. Where online, a lot of these orders are made to order. It's somebody orders it. The order gets placed to be produced and shipped, and you know you haven't had to incur any carrying costs. So that it really creates a downward pressure to stay competitive in the retail environment compared to online. And in many instances, it's a battle you can't win.
Yeah. Okay, let's kind of move on to the next one that I've seen a lot, and this is another industry that I see a lot of great people working in, but for some reason, when it comes, not for some reason, there's some good reasons, but when it comes to it, you know, banks don't really like it, and that is kind of construction.
Construction, yeah. This is very tough. Close parallel, let's say, to restaurants and retail, where generally speaking, from probably on the smaller scale, it can be a cash-based business, and then you run into the moral quandary of if I'm getting paid in cash for a job, large or otherwise, there's always this, you know, the question of, do I report this as revenues? And you know, obviously, as a bank, we're going to go on the revenues that we can see, but even on a larger scale than that. Some of the larger scale contractors and construction companies, here we have an issue as it comes to asset quality. And what I mean by that is if we're going to look at a receivable base for a contractor, a lot of issues with the way they bill, and they bill in a way that's called progress billing, in that they'll bill a client for certain milestones of completion of a project. Well, the bank's view of that is that's really ineligible collateral. Think about if a contractor starts a job and you're 50% or so the way done with the job, and either the contractor, you know, the business is starting to go out, maybe client's not satisfied, a bank is not going to be able to step in and collect the rest of that progress billing for work that wasn't completed. So it creates a lot of risk in that space.
Yeah, and the bank can't go in there and complete the work
Yeah,
either.
I don't know how to build a 6,000 square foot office space.
Yeah, and another thing that another thing that I see happen a lot with that particular thing is it's just that it's such a low barrier to entry.
Right.
And so you'll have a lot of people kind of just get a truck, get some tools, and they're out there doing it. And they
Right.
they don't have any experience actually running a business. They don't have any experience financing it. They don't have any experience going through the hiring process. They don't have experience on mitigating themselves against risk. They don't have experience in kind of protecting themselves from legal liabilities
Yep.
associated with it.
Right.
Like I've got a friend of mine that's been working on a house. He's doing a development of a nice house in the Austin area, and they went through about they're about $1 million into this project, and all of a sudden the contractor didn't set up things the way that they should be. What didn't educate his employees, and one of the employees there got hurt pretty bad. That employee is now suing the contractor, and he's going out of business. And so my friend is now stuck with this half-built building. That contractor is he's going to be sued. Like both, I think they're trying to get him personally, but he'll probably be able to get out of that, I think. But it's just those type of things. A lot of times, people when they just start up a business and they don't really think about the structure behind it, and we see a lot of that in the construction industry.
Absolutely. Yeah.
Here's another good, interesting one, because it's kind of really pertinent to right now. Let's talk about hotels.
Yeah, hotels. This is tough because I think you pointed this the other day. Is a very astute point. Is you're selling space, right?
Yep.
There's no long-term lease like you would see maybe with a commercial property where I have a tenant that's been a tenant for 20 years. We have another 15-year lease. The bank can take that information and project out some stability in terms of income. With hotels, you see at any given point, who knows what your occupancy rate is, because there's so many factors that dictate what you're going to be at from an occupancy rate. Is there a big event in town? Is there not? Is your location good? Is it not? How much competition is there around the area? I mean, there's a lot of hotels, and we're not just talking about big names as well. There's a lot of options out there. So
did the coronavirus hit and then
exactly coronavirus in this year's perfect example.
Everything
Nobody's
down,
traveling.
So.
Nobody's going to hotels. It's a very difficult space to run into.
Yeah. So but I actually have seen a very few banks that actually specialize in that. So that's something that would be good to point out is, all of these industries, there are banks that like them better than others. And so I've worked with a bank before that every time I got a hotel deal, I was like, I had a friend over there. I was like, hey, dude, run with this because I'm not going to be able to do anything with it. And then there's also the thing about certain hotels, if they're a certain size and scale, like if you're doing a Marriott in the middle of downtown Austin or Houston or something like that, you could probably get financing for that because you're probably a experienced operator and you probably have good financial backing. And then what usually happens with those types of deals is they go into what's called structured finance, and after they're built and they're generating revenue, they'll almost get kind of securitized off under certain terms, and private investors buy it, and the bank will facilitate that, but they're actually don't love to lend to those particular industries.
Yeah, it's tough.
Okay, here's another interesting one that I was thinking about the other day is, and it's the cannabis industry. CBD, all this stuff's kind of blowing up. We've got states like Colorado, Seattle that are legalizing marijuana and things like that. But it's been very difficult for banks to get behind it. Why is that?
It's tough on two fronts. One, we have the fact that because if something is accepted on a state level, it does not imply, and it's not, that it's accepted on the federal level. Well, when you have a large institution, a large bank that operates not just within all 48 states, but worldwide, there's a very large disconnect between operating and lending to an industry where it might be acceptable on the state level, but on the federal level, it's not. And so there's kind of that duality there of, is this an acceptable practice? Also, we don't. The industry is still very new. This is not a full-fledged. It's been operating for many decades, and we know the pros and cons of the business. That's the first side of the coin. The other side is, there's also a large degree, and I think we'll get to this with another industry, of potential reputational risk to the bank. If the bank is putting their name on something, lending and beginning a partnership with a company, and there's very bad press or something very negative happens, that's not only a reflection on the business, that then becomes a reflection on the bank, and a bank wants to avoid reputational risk at all costs.
Yeah, I mean, kind of just to think of it from the opposite way, like a company, for example. Let me tell you another industry that sometimes banks have problems with, and so people can really understand the reputational risk, and that is churches, Okay. I mean, we do lend to churches and
Right.
stuff like that, but think about it. Okay. Let's say you lend to a church and this church is very entrenched in the community and tithing goes down or whatever happens. And then all of a sudden they can't meet their obligations. What is the bank going to do? Are we going to go and foreclose on a church?
Yeah.
I mean,
Most likely not.
Yeah, you can imagine the type of backlash that you would get from a bank trying to close down a church. And so that's just an example of how reputational risk can have a real life effect on a deal. And so I think some of that stuff on the opposite way is on the cannabis industry, but it also goes into this next industry, which is like sexually oriented businesses, you know, the strip clubs.
Adult entertainment type.
Yeah, nobody wants to be associated with that. I mean, they might be really lucrative to the people that are involved in them, but you know, banks don't want to be associated with that. Sometimes they don't even want to take their deposits.
Right.
You know, a lot of times they don't even want to take their deposits, and because they just say, you know, it's not worth the risk for us. We're not making enough money off of it. It's not worth the risk of us. We don't support it, and so like let somebody else do that.
Right.
You know,
Absolutely.
Okay. A big one that we left off from the very beginning, I think, is.
I know where you're going with this one, I think.
Oh, really?
Yeah, I think we're going to go tech next.
Yeah.
Right?
Why don't you tell us why tech's so tough?
Tech is very difficult. This more or less. So with tech, I think you can have industries that are wildly profitable and successful. The issue is this is really where it hits home to Besim's earlier point of you more likely need a specialty lender in this space, somebody that truly understands. With tech, you have a lot of software and programming, maybe intangible, proprietary, intellectual property. Most banks don't specialize or fully grasp how to value that. I don't know how to value a brand new software program that helps the user do X, Y, or Z more efficiently and so on and so forth. Most banks won't lend into what they don't understand.
Yeah.
And tech is a great example of that because there's just so much intellectual property that goes into it.
Yeah, here's a great example. Let's say that program you're talking about, you go and you're $800 million into development, you need another $1 million to $100 million to finish it out. Like, if that goes bad, what's the bank going to do with a half, not even
a half-baked program?
That is basically useless to the bank. I mean, who's going to buy that? Exactly. And if somebody does buy it, you know what they're going to do is you're going to get like cents on the dollar, like minimal things. So it's very difficult. But like we said before, there are some institutions that absolutely are willing to dive into that space. You know, like we said, I think before, Silicon Valley Bank is an example of one that they specialize in that industry. They're based in California. They know the industry well. They know what's working, what's not working. They know who it is, and they feel more comfortable lending in there.
They have a pulse not only on the industry, but everyone that kind of has roots into that industry. And, you know, that makes them a very viable competitor in that space, but specifically as it relates to tech. Absolutely.
Yeah. Okay, let's get to the last one. And this one is going to be an interesting one, I think, because it's called money-based businesses. So are like, you know, payday lenders,
third-party processors,
people that transmit money across, you know, from, let's say, here to Mexico, where people are sending money to their family members, things like that.
Right.
Talk to me a little bit about why those are industry. Why is that an industry that banks have a problem with?
That's difficult because you open yourself to so much risk. In it's not just knowing the client that does those types of services, but that client then in turn has a bunch of other clients that if they're not fully vetted, they don't know them inside and out, you open yourself to issues, and this could be, you know, inadvertently. So it's not that the business is intending to do this, but when you're processing money transfers and you don't fully vet and understand your client base and everyone that's attached to your client base, you open yourself to issues such as money laundering, you know, with offshore accounts, and who knows where this money came from. Is it being scrubbed for some reason? Political issues potentially with funding terrorism and so on and so forth. It's something that the bank really doesn't view favorably just because we don't know where the money came from. We don't know where it's going. We don't know what it's funding. We don't know if the money is clean or dirty. That's a huge risk to the bank. Again, you know, more or less on the lines of that reputational risk, political risk or otherwise. It's a huge risk because we just really don't know the flow of the money in those situations.
You know, banks have a lot of regulation. The government pushes down a lot of regulation, and one of those regulations is called Know Your Client. And we have to have an in-depth understanding of who our clients are, who the beneficial owners are, where all the money that that business is sitting, where they're going, who they're doing business with. And it's so difficult to vet the thousands and thousands and thousands of people that are sending money overseas or getting like a 10-day loan from you and stuff like that. So most banks, not only will they not lend to this industry, a lot of times they're not even willing to open accounts for the industry. Right. This is also goes into so these are also considered like money services businesses again, is like ATM machine, cash ATM machines. Like banks don't want to have these private cash ATM machines. And another thing that people don't realize is jewelry stores. So because there's money laundering that goes through the jewelry business as well. So those are like all kind of encapsulated in that one industry. And it's really has to do with the risk and the bank's regulation and the amount of oversight. And the amount of oversight it takes to bank those, that translates into a lot of resources for the bank and putting a lot of money into it. And so especially if you're on the smaller side and you haven't done the audits yourself, if you don't have all the internal auditing, third-party auditing of your company yourself, banks don't want to touch it because it's going to cost them so much money just to have the accounts.
Right. Absolutely.
So, but I think that's a good list.
It's a very good recap.
Yeah, that's a good list for us today. I mean, I'm sure there's other industries out there, and every bank does things a little bit differently. But like we've said multiple times, talk to different banks. Different banks have different views on different industries. They're more comfortable with specific industries. They might be near certain caps with one industry that they're not with the other one. You know, talk to them, find the right banker, because even on a same bank, you might have two bankers that are their knowledge differs severely. And so, like, for example, like I worked at this one bank, and there was a guy that all he did was specialize in like nursing home and old folks homes, and nobody else in the whole bank could get anything done. But he got like literally every deal the bank did. He got almost all of them done. Yeah. So there's some bankers that really go deep dive on certain industries, and as you get higher in revenue and move up the bank into different levels of the bank, there's actually whole divisions of the bank that specialize in special industries, and they'll be able to do a lot more for you than the general banker.
Yeah, no, that's a good point.
So anyways, that kind of wraps it up for us today. Thank you guys for joining us. We're going to have some other great topics. Don't forget to email us, subscribe, and kind of let us know what you want to hear about. You know, we're here as a resource for you guys. This is something that we really want to share. And so let us know what kind of industries you guys are having issues, have seen issues with, or ask us questions about something specific. And we'll
just
do our
general
best
questions.
to
Let us
answer.
know.
All right. Thanks a lot, guys.
Thanks.
Take care. Bye.